I'm really honored to have a chance to be here today and to talk to you about microinsurance and the Milk Project that we did and the lessons that we learned from that. I call it the magical balance. I call it the magical balance because it's very easy to create products and services that are super beneficial to clients. We don't see it that often, but it happens. It's very easy to create products that are really beneficial to insurance companies in this case. Credit Life is often an example of that. But putting the two together, figuring out where the real value for clients is and where the real business case match for the two pieces, I think this is really the magical balance because that's what's going to drive microinsurance. It's going to be what drives the value. It's going to be able to drive the expansion of products and people and cover more and more people. Our objective in the MicroInsurance Centre is to cover 3 billion people with good microinsurance. And so we're working to do this all the time. And so the magical balance is really, in many ways, the key to making this happen. So I want to talk to you about value. I want to talk to you about business case. First of all, microinsurance. What is microinsurance? You've had 2 other speakers over the years talk about microinsurance. So I'm sure you all know. We're talking about, as Philip said, products that are specifically designed for the low-income market. And this is really, it's easy to say, it's not so easy to do, right? Because we're talking about product design, we're talking about processes. We're talking about even the pricing is different when we price risk for low-income people. So very specifically focused on the needs of low-income people, okay? So what is good microinsurance? Good microinsurance has to be suave, right? Does anybody know what suave is? Women always know suave, right? They know suave when they see it, and James Bond is a good example of suave, right? Attracts the attention. Immediately, the whole room turns to the suave person. Microinsurance has to be suave. It has to attract people. It has to get people to see this as something that's good and beneficial and important. And we say that it must be suave because it has to be simple. And this is where I'll talk a little bit about some of the differences between insurance and microinsurance, but it has to be simple. We talk about a policy that looks like a business card, not a policy that looks like a book. Simple products. We talk about products that don't have a lot of exclusions, right? So if you die, you don't have to worry about, well, did they commit suicide? Did they die by this or that or the other thing? If they die, they die. Simple products. Simple marketing, simple explanations, simple products. We also want products to be understood. We have a problem in microinsurance as well as traditional insurance, frankly. We have a problem in that people don't understand the policies they're buying. They don't understand what insurance is. So people will come after having a policy for a year, a life policy, for example, they'll come to you and they'll say, well, I didn't die, give me my money back. They're confusing because we don't help them to understand these microinsurance products. And understanding is really important. It has to be accessible. They have to be able to easily not only access their ability to pay premiums, but they have to be able to access claims forms and claims documents. We have to have simple procedures, accessible procedures, so that they can transact the insurance that they buy. It also has to be valuable to them. We're going to talk a lot about value as we go. And then it has to be efficient. When we talk about the business case, efficiency factors over and over and over again. We have to have efficiency in microinsurance. We have to be able to offer these products cheaply because we have to have a price point that low-income people can afford. So we have to be efficient at every level. So we'll talk a little bit about that. So one thing to remember, if you go away today and you remember nothing else about this fat guy who stood up here and talked about microinsurance, remember suave, okay? Good microinsurance is? Okay, one more time. Good microinsurance is? Excellent, excellent. Okay, now I'm done. Bert, you can come up. No. So good microinsurance is suave. I hope you've seen some of the differences between microinsurance and traditional insurance. Okay, so let's talk about value a bit. So value is not just calling yourself a quality life insurance company or the rock of this or that, right? It's not just in your name. You have to be it. You have to act it. You have to show people. You have to prove it. And so we look at value in 3 levels in the Milk Project. We look at expected value. If I go out and buy an insurance policy to cover the health of my children, I'm going to feel more confident that if something happens to my children, I can take them to the hospital. I can take them for care. If I feel more confident, then maybe I'll invest more money in my business. Maybe I'll make more money because I'm able to more effectively use my money because I'm not so worried about my children, about my children's health, because I can take care of that. Okay? So the peace of mind effect. What are you buying it for? What are you going to do? How are you going to do differently? Okay? We're also looking at service value. What are people getting? Might they use services better because they're insured than if they're not insured? We certainly find that when you have a health insurance product, people take better care of themselves. They get better care. They stay healthier. Health outcomes, positive health outcomes, because they have a health insurance product. Okay? And then we look at the 3rd level is financial. And this is where we spent much of the time with the Milk Project, looking at the financial benefits that people got in microinsurance versus traditional mechanisms for risk mitigation. And so we saw that people have lots of different ways of dealing with crises, right? You've got savings. You can use your savings if you've got any. You can reduce your investment in your business. You can reduce your spending. You can sell your assets. You can get formal and informal credit. Even some people, they have no response. The response is, frankly, I'm going to go to the village and die because I don't have the money to go to the hospital. It's crazy to me. It's crazy. Okay? So what we want to understand is, where does insurance fit into this pie? How does insurance reduce the needs for people to use some of these mechanisms? Okay, so what we looked at, so we went around and we were opportunistic. We developed our own methodology for you academics. I know there's a lot of students here. We developed our own methodology called client math. And in client math, what we do is we basically identify a particular issue, say death, and we go to an area where we can identify people who have experienced that issue and have been insured and were not insured. And then we can look at, of those mechanisms that we saw before in the pie, what of those did they use? How much did they use? How much does the issue cost? And how much of those things do they use? And so what we look at here is, what was the cost? And so if we look, we can see we've taken all these products and we've broken them down into weeks of those people's labor. So the average daily cost or weekly income, I guess, is different for all of these because we're using the specific incomes of those groups. And so we see relatively little for outpatient care, which we'd expect. A little bit more for floods and catastrophic issues. Hospitalization, still a little more. Big one is funeral. And this is one of the biggest detriments to people's economic welfare. And the reason is because there are so many strong cultural norms and cultural requirements around funerals. And so people end up spending a huge amount. Stefan Durkhan, the chief economist of DFID and from the professor from Oxford, did some studies in Ethiopia, and he said that people in Ethiopia, when they have a breadwinner die, it takes them 10 years to recover their economic position. 10 years. 10 years, it's like most of your child's schooling. It's like all that education, the nutrition, all that is lost, okay? And so this is what we find in terms of cost. And then what was interesting to us is, how do they finance that money? Okay? Where do they get that? What's the components of those different strategies in the pie, right? And so we look first at the simplest ones, right? And we've got cash on hand. So cash on hand, using some cash, cutting some costs, very common for outpatient care, for example, but 61% of people use this mechanism. Next mechanism is loans. So they get loans from family, they get loans from friends, they get gifts, usually no or low income, no or low cost. And almost 2/3 of the people use these mechanisms. But what that does is it bleeds money from other uses in the community to pay for healthcare, funerals, disasters. Okay, about 1/4 of the people use their savings balances. And generally what we saw was that when they used their savings balances, they used all their savings balances. So they eliminated a good chunk of their resiliency for the next risk or the next problem. They got bank loans, which were expensive. They got other credit, which include money lenders. It's a very expensive money. These events always cost low-income people more money than it does for people with money, wealthy people, because they have to pay all these extra fees and these extra interest. And they have, even here, they have social obligations that they pick up, right? And then here, 10% of people, they sell assets. So like I was in Cambodia a couple of years ago, and people I spoke to said, well, when we get sick and we need money, we sell our rice paddy. But isn't that how you make your money? Yes. What do you do afterwards? We struggle. We sell our assets. We struggle because we have to do those things. Who of any of us are going to sit back and say, no, I don't want to sell the rice paddy, I'll let my child die from sickness? No one will do that. You do what you have to do, but then you end up in a much worse position. So what we see is that insurance helps us in many ways to improve these, to improve the mechanisms for managing risk by low-income people. So some of the lessons we got. Microinsurance has to be affordable, okay? Not rocket science. It has to be affordable for people, but it also has to deliver on its promises. Right? One of the things that we learned is that when we say we're selling a funeral policy, we should be able to pay that funeral policy within a couple days, before the body's buried, while the funeral is happening, so that you've got the money to deal with those things. And what we see is that insurers often take much longer than that. We're not honoring, as insurers, we're not honoring our commitments. And when we don't honor our commitments, it makes it very difficult for us to grow and expand and to prove to people that insurance is a good thing. And so what we found also is that when we look at say, a funeral, for example, we did a study in the Philippines. We looked at an institution that paid their funeral policy in 45 days, which is obviously way too long. We found another one that paid within 3 days, which is a reasonable amount. So we looked at what people did with that money when they got the insurance money, and we found that people who got the insurance money in 1 day, they used it for the wake. They got it in 3 days, they used it for the funeral itself. They got it in 45 days, they used it to pay off some of the loans and the debt that they had accumulated, but they also put some money in savings. They put some money back in their business. What we have to start doing as insurers is to start thinking better about what exactly are we covering, and how do we make the products more valuable to clients. Okay? We also learned that microinsurance is not alone. We have all those mechanisms. You saw those percentages for the different types of strategies. Nobody just uses insurance. Those who are insured don't just rely on insurance. They still use generally the same number of mechanisms as the uninsured. But what's important is that they use the ones that are less stressful. Those that are insured are not the ones that are selling their assets. Those that are insured are not the ones that are liquidating their savings. Those that are insured are the ones that maybe are using a little extra cash out of their pocket because they know they're going to get it back. So they use the same number of mechanisms, but they don't use them. They don't use the difficult and challenging ones with the same intensity, which is actually very positive for them. So costs are lower, issues are lower. And then what else? We can see that microinsurance can be offered as a value-added or can add value to the family, even if you don't get claims. Right? Even if you're not a claimant, you can get benefits because you get the peace of mind. You can make better investments, better decisions, not worrying about those risks. And so people tend to do better and move forward better. So I want to talk about business case now. And business case for us, basically profitability. Fundamentally, if you're going to have a business case, you need to have profitability. There are several other things that we can consider in terms of a broader business case definition. Allianz, for example, they say, what we want to do is create a market for the future. And so we'll insure all these low-income people now so that when they move into the emerging middle class, then they'll be our clients already. So we'll make our profits then. Zurich says, we want to learn lessons from how to serve these people efficiently that we can then apply to the upper market. So you have other mechanisms, but also fundamentally, you need to have a profitability motive. I'm not interested in insurers who just want to do this for social reasons. It's not healthy, and it's not good, and they often don't work. So what you need is institutions that are looking for profitability. So we're looking for very simple calculation, right? Covered lives times the unit premium, how much money is coming in. Covered lives makes us focus on volume. We need volume. We need scale to be able to make microinsurance work. These tiny little programs are just not doing it. It costs too much. We also look at the effectiveness of distribution. Distribution drives microinsurance. That's what makes things happen in microinsurance. Insurers aren't going to sell products directly and get any kind of volumes. So distribution drives that. Enrollment method, is it voluntary, is it mandatory, is it automatic? These all have a very important impact on cost, so on profitability. So unit premium, the premium of course must be affordable, the claims must provide value. Then we look at fixed costs and variable costs, and this is really the key to making microinsurance work, is how do we reduce those costs? Because the more we can reduce those costs, the more we can create value here in claims, which adds value to clients if they're able to cover more of what they're doing. And and so some of the key issues that we look at here, the business model, the home office costs, systems, how efficient are your systems? How costly are your systems? The variable costs. We worked with an institution in Ghana, and they went out to the markets, and they sold products to people in the market one by one by one by one, every day. Every day. It's crazy. The costs were outrageous. The volumes, the productivity was terrible. You could never have a business case there. Okay? Then this company moved to servicing groups. Group insurance, the same kind of evolution that many of us have seen in our countries over years, right? They went to group products, so they sell through microfinance institutions, through rural banks. They've had tremendous growth. They went from, I think, 57,000 people 2 years ago. Now they cover 1.5 million people. Okay? Scale is what's important. Efficient systems that allow you to manage that scale. It's critically important. Distribution costs. How much are we paying in commissions? To our partners, we see commission rates everywhere from 5 to 60% in Nigeria, where I was just recently. The telecoms are charging 60% commission on premiums just to let the product go through their network. 60%. How can you have a profitable product if 60% of it is just going to the distributor? Can't have profitability, can't have value. It's very hard. So this calculation guides all these discussions and all these thoughts about profitability. So profitability, microinsurance profitability relies on massive scale at minimal cost. And that's it. If you can't get scale, you need to be thinking about something else. If you can't reduce your costs, you're not going to get to where you need to be. So what we find traditionally, what we see in insurance, is that the greatest level of costs are in claims, then in your distribution and admin costs, and then you get some margin, some smaller margin. And this is typical insurance business. What we see in microinsurance is we see this turned around, where we see that the largest piece are the admin costs. We have to bring those down. We have to cut those down to allow better opportunities. And this was very clear in the work we did with milk. And so claims, you have claims at a reasonable level, but here you have in this example a 13% loss in your margin. Not sustainable. They've got to be able to address their admin costs. And they tell me for 2014, they've dramatically reduced admin costs, and now they expect to be profitable by between 5 and 10% this year. Okay, focus on the admin. Okay, here we have admin at 60%. This is from Columbia. Admin at 60% and claims at 21%. So the margin is 19%, almost 20% for the insurer. So it works at least for the insurer, but the client is getting limited claims. And the admin here is represented by 45% of the total premium. So 3/4 of that 60% is paid to the utility in Columbia that is the distribution channel for this. These kinds of commissions make it very hard to have profitable, effective products. A profitable and effective product would have a positive margin, and it would have better claims ratio, okay? And certainly much lower admin. But this is commonly what we see is this admin problem. How do we get the costs down? Okay, so we need to evolve. So I want to talk about, the Philippines a little bit, which is a market I really like. Philippines is a market that's about 15 years old in microinsurance. And if you look here, you've got the same kind of triangle, right? You got claims at 46%, the total distribution and admin is 28, and you've got a margin at 26. That margin can still come down. They can still do some things with that. But if you look at what happens then, you take the distribution, the 21% here. What that is for the distribution channels, most of which are microfinance institutions, you've got costs of 13%, and you've got a margin of 8%. So the distribution channels are making some money. They're covering their costs. They're making some money. The insurer's making some money. So what about the client here? What we see when we look here, and I think this is really fascinating. You see an increase in the premium revenue of 250% between 2008 and 2012. How did that happen? How did they grow so fast? What they had was they had good distribution channels, but they improved their service. They improved their service, built additional value into products. And what drove that was competition. Competition in service. And so now you see you've got substantially more premium coming in, but you've also got a loss ratio. This is total claims over total premiums. Was 21%, relatively low, is now 46%. Almost half the premiums go back to clients. And the insurers are profitable, and the distribution channel is profitable. We're in a nice balance here. Okay? We could tweak and improve things in some areas, but what we've got is a nice balance on all parts. And what drove that? Competition drove that. And that's important to remember. What drives the market in the Philippines now is not price. It's competition. One of the insurance companies we looked at deliberately undercut their price so that they could grab market share. It turned out to be a dismal failure for them because then they didn't have any money to service properly or the inclination to service properly. But this is a market where people are looking for good service. So evolution of these products, evolution of service, evolution of these insurers, I think this is a really good example in the Philippines. And so what kinds of lessons did we learn from the business case? We learned that maximum scale, minimum cost, okay, which we talked about before. We learned that health, comprehensive healthcare insurance is virtually impossible to do in a microinsurance environment without some kind of a subsidy. Comprehensive healthcare insurance. Okay, we looked at maybe 10 of these different institutions in India and in Kenya. You can't do it without subsidies. It just doesn't work. The admin costs are too high. And oftentimes we're competing against government programs that will absorb huge losses. So it becomes very difficult to do that. Life products, almost universally, are profitable, oftentimes too profitable, I would say. okay? We've got some property products. They can be profitable or not. We have some life products. What we focus on is what's the gap in the healthcare needs? And we try to provide funding for those things through insurance, and those kinds of hospital cash programs or gap programs, they tend to be profitable. Okay, so you do have some profitable levels within health and some important benefits. Subsidies may be necessary for healthcare if we're going to have it be profitable, and for agriculture too. For agriculture insurance, I think almost for sure we're going to need subsidies. And one of the arguments is that in the North, the US and Europe, our governments all pay subsidies for agriculture insurance. So we should be doing the same with low-income people. Admin costs drive the health costs. If we can get those costs down, so if investors out here can start thinking about how do we develop some way to get those costs down, to make products more efficient, then we can maybe move better towards appropriate products and growth. Here we look at this 22% again. This is the same example from Colombia that we looked at before. So here's your 22% and your 45% commission down to a total here. And so what we've got here is this graph that we've developed for where people use their money. When the event happens, when the death happens in this case, where do they get the money from? And so we see here that the insured use very little savings, you use little income, a little informal loans, no reduced consumption, some gifts. But the uninsured, they deplete their savings, they use a similar amount of income, but they get into informal loans. They end up with all these costs, interest costs. And then they get into reduced consumption, which is taking your kids out of school or nutritional deficit. So this is a picture of a very positive example of a product with some real value to clients. So now you've got real value here, but only 22% of the claims are going back to clients. So those who do claim are getting substantial value. How do we balance this better? And part of the answer here is with this distribution costs. And so how do we figure out how to improve those costs? And that's where the real key is, getting these costs down. Here we look at another one where we have a reasonably good healthcare product in Kenya. But what we end up here is with claims of 104%. So there's more claims than premiums. Everything else is lost. So you've got a decent product for clients, but a very poor product in terms of business case. We suggested that these people stop. We didn't see a way that even with volume, they could cover their costs properly. So the importance of this balance is what is critical. We look at evolution very quickly. This is the Philippines again, because I like it. It's a nice picture of where microinsurance goes. And so you see where the NGOs started with credit life, just covering the loans. They went on to life products offered to the clients, then products offered to family members. Then the government allowed mutual benefit associations. So most of the big MFIs created their own mutual benefit associations. Card Bank is probably familiar to many of you, or Card MBA. Then they went on, they started offering endowments. Then they started purchasing non-life insurance, expanding the product range. Then the government set up a framework. They did market education. They let the rural banks start to act as agents. So expanding the market and creating a facilitative environment, the government did, to make insurance work. Rather than telling everybody they had to do microinsurance, they made a facilitative environment. So now you have better distribution, you have this service push that we talked about, and now in the Philippines you have 21% penetration. 21% of all the people in the Philippines get some kind of microinsurance. Very substantial, very important. And I think what we need to be thinking about is, how do we speed up that evolution? How do we make this go faster? And I think as we learn more of these lessons, like from the Philippines, I think we can start to learn how to move faster with these, okay? I just want to talk about just one more thing. I think it's important for all of us to think about the future and where we're going. And I think that what's happening is now we're moving into what I'm calling microinsurance 2.0. It used to be, and we talk about microinsurance. We stand here today and talk about microinsurance. I would bet in another 3 years, we won't really be talking about microinsurance anymore. We'll be talking about insurance. We'll talk about special products in insurance for low-income people, but we won't talk about microinsurance. It's becoming much more part of the mainstream insurance. We're also going to see low penetration. We see most countries, if you look at all of Africa, you take South Africa away, only 1.7% of the total population gets microinsurance. So we have really low penetrations. We're going to see much more larger distribution channels, moving away from microfinance institutions more towards mobile networks and such. We're going to go from high touch, where there's a sales process, where people are talking to you and selling the product, to low touch, where you're expected to buy it off the shelf. There's a lot of transition that has to happen here. We have to think about who's actually going to do that. So one of the concerns I have in this move is what's going to happen with the low-income people. We know that wealthier people, people who have insurance with financial products, people who are not women, men, will buy products with low touch much better than they will with high touch. So the high touch is really necessary for women and these other groups, women and the poor. So I don't want to see this movement into the mass with low-income people being left out. We have broad products now. Here's a life product that we've got. We'll have more nuanced products as we go forward, covering what and when and how do we pay it. We also have limited consumer protection now, and I think there is a lot of work going on right now to create appropriate consumer protection for the low-income market, and I think we'll see a lot more of that as we go forward. So just some thoughts about where we're going, Microinsurance 2.0.